Hello everyone. Today I will be discussing about securities. Now what are securities? So if I'll talk about what are securities, securities are some financial instrument which are issued to raise the fund. As we are aware that whenever we want to raise funds, we need some kind of securities. So securities are divided into different parts. So first is equity shares. That means I can raise funds with the help of equity shares. Second is debentures and bonds, or even I can say debt. Third will be mutual funds, and fourth will be derivatives. Now let's discuss all these four types of securities one by one. So first of all, I'll be talking about equity shares. What are equity shares? I'll just suggest you before watching this video, please go through my previous video in which I have just talked about what are equity shares, what are preference shares, what are debentures, what are bonds. So just giving a recap, I have discussed a small story with you in my previous video. The story runs like this. What I have discussed that suppose you are moving in a plane and your flight is from Delhi till Beijing. That means if you will see the sitting capacity of the plane, there are three kinds of categories: your business class, your first class, and your economy class. So, what I am considering, business class is the topmost class, then comes the first class, and then comes the economy class. So, obvious in business class, the ticket charges will be high, and in the economy class, the ticket charges will be less. So major benefit will be given to your business class and least benefit will be given to your economy class. But if you will see the sitting arrangement, maximum number of seats are there for the equity shares for your economy class and least number of seats are there for the business class. So that means the plane is earning revenue from the economy class, but still less number of benefits are being given to the economy class. So what we are doing, we are considering economy as a equity shareholders, your business class as a debentures, your bondholders. So for more detail, please go and watch that video. Now today we are going to discuss what are equity shares, what are its features. So the first feature is whenever you raise money with the help of equity shares, you get the ownership of the company. Because the equity shares considers all the investors as their owners. They make them as a partners. So if the loss, company is in a loss, these owners have to bear it. If company is in profit, they are the beneficiaries. That means all those shareholders which are having the equity shares, they will get the part of profit. Now voting rights. Now what do you mean by what voting rights? Now, once we are saying that all the equity shareholders are the owners of the company, so that means whenever the company has to take some decision, all the shareholders will have to vote for that particular decision, whether they agree with that particular decision or not. But now consider there are so many shareholders throughout the world. If I am issuing the equity shares, my company is there. So many shareholders throughout the world will be purchasing my equity shares. So there are various owners of my company. So it is very difficult to gather all the owners under one roof to make any decision. So what they do, they give the voting rights. That means you have to elect your representative who will take decisions on your behalf. For example, you go for the president election. So that means the prime minister and the president has the right to take decisions on your behalf. We give them the right. Similarly, voting rights are given to all the shareholders. They give the right to the person who will take decisions on their behalf. Next comes the dividend income. Now, since the equity shareholders are the owners of the company, so they will get the part of profit, and the part of profit is given in the form of dividend. But it's not sure that whether you will get the dividend or not. It can also happen you get the dividend but not from the complete part of profit. For example, company has earned 100 rupees. So it's not the guarantee that all the 100 rupees will be distributed as dividend to the shareholders. If business has some good opportunity, investment opportunity, or the owner wants to expand the business, they can retain that money also. So it can also happen that 100 rupees is earned as a profit. Company pay you 10, 20 or 50 rupees as a dividend and rest of the money is being retained in the business. Next is fluctuating rates. Now, our share price depends on various factors. Some factors are controllable and some factors are not under our control. For example, natural calamities, or for example, COVID. COVID came. So, when the COVID came, the share price fluctuates. Or let's say presidential election. Or let's say the latest example, the US tariff. So that means, or you can say budget. Government has introduced some new budget. Or any monetary policy, fiscal policy. Or even dividend. So these are the various factors by which the rates fluctuate. So whenever you talk about equity shares, the fluctuating rates are there. High risk. Since rates are fluctuating and equity shareholders are those persons who get the dividend after paying everyone. So risk is high. Permanent capital. Now whenever you are issuing, that means as a company I am issuing the equity shares and you as an investor are investing in my company, so company is never going to return back your money unless and until company himself wants to buy back. If the investor wants to sell the shares, they can go to the secondary market and sell the shares. So that means as a company, if I have issued equity shares, so it's my permanent capital because I'm not going to return it. There is no maturity period in it. Residual claim. Now, residual claim says that suppose something happens to the company, companies go bankrupt, or the owner is shutting down the company. So, if something is left, shareholders, equity shareholders can claim that. Transferability. As I have discussed that equity share is a permanent capital, so company is never going to pay back your money because no maturity period is there. And somehow, suppose you are in a need of money, or you are saying that the price are fluctuating, prices are going up, you want to earn money, so you can sell the shares to some other party. So what the company will do? Company will just transfer the name. Now, in today's date, you are the shareholder. Once you sell the shares to Mr. X, so from now onward, Mr. X will be the shareholder. Now, let's talk about debentures and bonds. Debentures and bonds, as we have discussed with equity shares, they are not the owners of the company. So, no ownership of the company. Why? Because whenever company is issuing debentures or bonds, it is considered that company is borrowing the loan. Company is taking the loan. And loan means you have to pay it back. So since you are not the owner, so you don't have the voting rights also. And since the company has borrowed the money, so company has to pay the interest money. So as an investor, you will have the interest income. Now, interest income is not related to the profit. Whether the company is earning profit, whether the company is in loss, or whether its company is having the business or not, or anything happens to the company. The company will pay all its debenture holders and bond holders the fixed rate of interest. That we name it as a coupon rate. On the basis of coupon rate, the company is going to pay you the interest. Relatively stable value. So as we have discussed in equity share also, the prices fluctuate. The same happens with the debentures. But debentures and bonds have a maturity period. So as compared to equity shares, the price fluctuates but not at that speed that the equity shares. So we can say relatively stable value is there. Low risk. Now I know that if I am taking debentures or I am taking the bonds, I will get the fixed rate of interest. Whether the company is having profit, loss, I am not concerned, I will get it. Similarly, if you take loan from the bank, You have to pay the interest. So for the bank, giving the loan is having low risk. Temporary financing. Now, debentures and bonds have a maturity period. That means the company has to pay back the money maybe after 2 years, 5 years, 10 years or 20 years, whatever the maturity period is. So whatever funding the company is getting is for a short period of time. So we can say it's a temporary financing. Residual claim. You can also claim at the end, suppose the company becomes bankrupt. So debenture holders and bond holders have a backup of the assets so they can claim it. Transferability. As we can sell the equity shares, we can also sell the debentures and bonds. Somehow, let's say I've taken the bonds for 10 years, but after 2 years I need the money. So I can sell it off. I can transfer that bond. Now, mutual funds. Mutual funds, okay, let's discuss this with the help of example. Let's say this is one of the customer and he wants to taste the pizza. So he went to Pizza Hut and ordered one cheese pizza. Let's say the cost of the cheese pizza is 500 bucks. So he paid rupees 500 and purchased the cheese pizza. Now after tasting this cheese pizza, he is a customer who has never tasted the pizza. This is the first time he is doing. So he can like the taste or he cannot like the taste. If he liked the taste, that means he is satisfied. But if he didn't like the taste, he is not satisfied. His 500 rupees are wasted. Similarly, suppose this is a second customer who has just gone to the Pizza Hut and again she purchased the mushroom pizza. She is also having the first time. She is tasting this mushroom pizza for the first time. And the same thing happens if she likes this pizza. She also spends rupees 500. If she likes the pizza, well and good. Otherwise, her 500 are wasted. Third customer, he also the first time went to the Pizza Hut and he ordered tomato pizza. All these three customers are new for the pizza. Now, all three have invested 500 individually. Now they cannot go to the pizza corner and then they can say that give me one slice of cheese pizza, one of mushroom and one of tomato pizza. Mutual or this Pizza Hut will never do it. So that means either they like the taste, so they have recovered their 500. That is not wasted. If they didn't like the taste and they throw that pizza, so their 500 is wasted. So that means all the money, whatever money they are spending, that depends on just one choice because they have only 500 rupees and from 500 they can either purchase one of the pizza. So high risk is there because they don't have choice. No diversification is there. That means they cannot go to pizza corner and they cannot say that if in one pizza 4 slices are there, 6 slices are there, so don't give me for one pizza, only give me 6 slices of different pizza. No, they cannot say. So I cannot say that no diversification is there. So high risk is there. Now let's say we talk about case 2. Now these three customers join hands together. And what they do? They collectively collect 1500 rupees and then go to the pizza corner and then purchase 3 pizza collectively. Now when they are purchasing 3 pizzas collectively, now what they can do? They can share it. Suppose this person, first customer, did not like cheese pizza. So what he can do? His money that is invested in cheese pizza is wasted. Now everyone has pooled 500. So that means in one pizza, 1/3 of 500 is invested. So if he didn't like cheese pizza, he has other 2 options also. He can just taste mushroom pizza or tomato pizza. So his 1/3 of the amount is wasted, but 2/3 of the amount is saved. And the same case goes with other customers also. So now what they have done? The money is spread out across different choices. So there is low risk. So there is no risk that complete 500 is gone. Yes, amount is gone, but a lesser amount. So low risk is there. As diversification was there. So collection of securities means your mutual funds. So the first feature of mutual fund will be pooling fund with others. So what they are doing, they are pooling the fund. That means various people who wants to purchase the securities, they are coming together and then they are purchasing it. But now the question arises, if I have to pool the funds, so do I know that which customers are there who are ready to pool the funds and where to invest? No. For example, if you are saving the money, right? Now, if you are saving the money and you want to invest your money, you don't know that which person needs loan. So what we do, we save our money to the bank, and then people who needs loan, they approaches to bank only, and from our savings, the bank give loan to the person who is in a need. So that means bank becomes a mediator. There, all the people who have excess money, they will go and save, and all the people who are in a need of money, they will go and collect the money. So what we do, we have professional investors who invest in mutual funds. So they pool the money, they collect the money from different investors, and then collectively they purchase the securities. Now, since they are collectively purchasing the securities, so what they are doing, they are investing the money of the investor in different funds. For example, let's say company A share price is worth rupees 100. That means one share will be 100. Now, if I will invest, I have to purchase one share. Company will never give me a half share or 1/3 share. So I have to purchase complete one share of rupees 100. Now what I'll do, I'll give my 100 to professional investor. Now he will collect 100 from different people. So this professional investor will have, suppose it collect 100 from 10 people. So it has 1000 rupees in his hand. So now he can purchase 10 different securities. And he can inform me that I have invested, this professional investor has invested 1/10 of my amount in one security. So if somehow one security is in a loss, my 9 securities are in a profit. So I have a diversified basket. Reduce risk. So if I am diversifying, I am not losing my complete money. Only a part of money will be reduced. So risk is reduced. And I will be getting the shared return. I will be getting the returns from all the securities. Who has invest? Mutual fund investors, professional investors has invest. And then when they will get the returns, they will distribute that returns to all the investors. So hence we can say it is a collection of securities. Now next comes our derivatives. So derivatives are the financial contract whose value depends on another asset. Okay, let's discuss its features. So the first is, it says that value depends on underlying assets. Now underlying assets means there will be some asset by which I am going to take a derivative. Okay, let's understand in this way. Suppose think of some movie. You want to see some movie. So what you will do? You will buy a ticket. But if you have purchased a ticket, that ticket itself has no entertainment value in it. Its value comes from the movie being shown. That means you feel entertained when you are going to the theater and seeing the movie. And if the movie is a blockbuster, tickets are in high demand. And if the movie flops, tickets demands fall. Similarly, a derivative value depends on the underlying assets. Let's say your stock. You purchase a share of XYZ company and there is a demand. So your share price increases. And demand falls, the share price decreases. So what I am doing, I am contracting for the future price. Maybe gold, maybe oil. So the value depends on some underlying assets. No direct ownership of the asset. That means you have predicted the value of that particular asset, but you have not purchased. You don't own that value. For example, imagine you want to go for a holiday, right? If you are going for a holiday, what you will do? You will book a hotel room. So if I am going for a holiday, I will book a hotel room online. But you don't own a hotel. You are not purchasing the hotel. You just have a right to stay in it for a particular period of time. Similarly, whenever you are purchasing the derivative, you don't own the commodity. Only a contract is linked to it. A third is used for hedging and speculation. Now, hedging and speculation, first of all, let's discuss about hedging. Hedging means protection against losses. Now, let's talk about some example. Let's say you purchased a car. Now, whenever you are purchasing a car worth rupees 10 lakh, now what you have to do, you will go for an insurance. Now, why you go for an insurance? You have a fear somehow in the coming year some accident place. So whenever accident will be there, you have to repair your car. So all the damages, whatever amount you have spent on repairing of your car, that will be covered by the insurance company. So because you have a risk, you get your car insured. Or we go for a health insurance. So whenever we go for a health insurance, we pay a premium, a small amount of premium. If I am going for a health insurance of rupees 10 lakh, so I am not going to pay 10 lakh. I'll pay a premium of 10,000, 15,000, 20,000. That is small amount. Why I'm doing the premium? Somehow in the next particular year, I fell ill, I have to pay the hospital bills. So that will be recovered by the insurance company. So I'm protecting myself against the losses, that means I am in a risk that if some losses or some expenditure happens, so that I am passing that losses to the insurance company. So similarly, investors use these derivatives to protect themselves from the price fluctuations. Suppose there are two persons. One person thinks that price of XYZ limited stock will go down. So it has a risk that now it is costing 100 rupees and after 1 month it will be 50. So it has a risk. So he will purchase derivatives. Similarly, suppose another person who don't have a money right now to purchase that share, and right now the price of the share is 50 rupees. And he has a fear that after 1 month the price of the share will shoot up to 100 rupees. So again, he has a risk. So he will go for a derivatives. Now let's talk about speculation. Speculation means earn profit by predicting the future price. For example, let's say some cricket match is there and you go for a betting. If your prediction is correct, suppose you say you bet on Mr. A that he will win. So if your prediction is correct, you win. If your prediction is wrong, you lose. So similarly, the derivatives takes place. So if the investors buy or sell to profit from the future price movement. If suppose you think that price will move up and it moves up, you win. If you think that price will move up and the price moves down, you lose. Next is traded in exchanges. All these derivatives are trading in stock exchanges. Now the question arises, why? The exchanges contract have a fixed rule. For example, if I talk about pizza only, whenever you go for a Pizza Hut or your Domino's to purchase a pizza, they have a fixed size. The size will not depend on you. Or if you go and ask for half pizza cheese, half pizza tomato, so they are not going to give you. They will give you full pizza. So similarly, exchanges also come with fixed sizes and fixed rates. And last is high leverage. Leverage means control a large value with a small margin. For example, as I given you the example for health insurance. Suppose you have the insurance of 10 lakh, but you pay a premium of only 10,000. So giving a small value, you enjoy the benefit of large amount. Or let's say, take example of hotel. You book a hotel room. Let's say you book a hotel room of Taj, but you don't own the Taj hotel. So by just giving a small premium, you can enjoy the benefit of staying in that Taj. So that means you have a control on large value. That means all the space of the Taj, but giving a smaller value. So similarly in derivatives, you control large derivative position by giving a small margin. So we have different kinds of derivatives, for example, your forward, future, options and swaps. And we will be discussing about these derivatives in our next video. Hope you have able to understand whatever the concept of securities I tried to discuss it today. Thank you.